mode.
Hello, active traders, and welcome to How to Trade Strong Chart Patterns. I'm Ken Calhoun, president of TradeMastery.com, and I'm joined here by very popular young educator Sasha Evdakov. Sasha, it's great to have you here with us tonight.
Hey, thanks for having me.
Sasha, he's written a dozen books already and on Amazon, and they're very well reviewed, and he's also got an extremely popular YouTube channel, which is how I first heard of him. So for those of you who may not be familiar with Sasha, he's got outstanding technical chops and a very clear, very accurate, very intelligent way of helping traders learn how to trade different patterns in the market. So he's one of the good guys. He's got my endorsement. So be sure to check out Sasha at tradersfly.com and his YouTube channel at YouTube Traders Fly. He's got some outstanding YouTube videos plus content. So Sasha's going to do the first half hour, then I'll do the second half hour. As always, all information is for educational use only. We're not making any advice about what to buy, sell, or hold. By watching this, agree not to make actual trades. So with that, let me hand the presenter control over to Sasha, and we will get underway.
Okay, show my screen. All right, let's see. Let's make sure we're sharing the correct screen. I have a couple monitors here, I believe. Let's see, which one is it? It's going to be
not that
3,
one.
4.
That's your primary monitor.
There we go. I think this is the right one. It has my face, and it should show some charts here. Are you guys seeing what I'm seeing, I hope?
Yeah, wow, looks great. We can see you. Looks outstanding.
All right, wonderful. Yeah. Okay, I'm going to keep my headphones on just in case to hear things. So I'm going to do a couple of chart patterns. That's kind of my goal. Thank you so much for joining me today. For those of you that have had webinars before with me, there's going to be no Q&As. For those of you that are new, hey, thanks for stopping by. I'm going to show you some simple chart patterns here that I like. And I always like to keep things very simple because I find that the more complicated you make things, the more, I guess, convoluted the trades become. So here's a couple things that I would like to cover. We're going to break it down. So if you want to write this down or during the recording, you can reference it back. We're going to cover the ABCD pattern. Okay, here's some stocks that I'll be looking at. I'm going to try to do an example of each one of these real quickly. And then if we don't have time, you can run back and take a look at some of these other examples here that I've listed. We'll take a look at a stair-step pattern, which kind of moves like this, consolidate and break, and then a break and a retest. So those are the 4 key ones that I'd like to cover. Now, of course, there's many more patterns out there than just these, but I find that keeping it simple is really best. And these patterns really, I guess, make life a lot easier. So the more patterns that you have, they'll start to get very complicated, and as they get more complicated, the trading becomes skewed, and you start to really wonder, well, should I get into this trade? Should I get out of this trade? Is it really the right trade? So if you have a pattern that's really easy to recognize, you have a much higher probability of success. So that's kind of the goal for these patterns. So again, take a quick look here. These are the ones that we're going to cover. I'm going to start it out with one pattern of each. And we're going to first head on over to Tesla right here. So normally this is the TC2000 platform for those of you that aren't sure what the platform is. We're going to go in, and normally I look at charts from a monthly perspective, then I get into the weekly, then I get into the daily. Most of these patterns will work on all these 3 time frames. However, keep in mind, for getting started in this and learning about these patterns and starting to recognize them, you'll probably want to start either with the monthly or the weekly. You can also do it on the daily, but for a lot of people, it gets a little more messy. So I'm going to try to show you as clean as possible charts, because that's where the success or probability of success of those patterns working out are more in your favor. Keep in mind, you're always looking at price action and behavior with the volume. That's kind of the key. So with that being said, let's start out with Tesla. And here we have an ABCD pattern. I'm going into the weekly. And what an ABCD pattern looks like, and I'll just show you here at the beginning, and we'll evaluate these charts a couple of times, and you'll see how they look and work out. And keep in mind, some charts will fit into 2 or 3 categories. All these chart pattern names are simply just names. We can assign the color red to a certain color of an apple or a red Ferrari, but the shades might be slightly different. So the same thing here. You can assign it whatever name you want, but keep in mind that the core principle is still the same. So in either case, looking at Tesla here, an ABCD pattern is all about knowing and understanding swing points. Swing points is where things change direction, which are over here at these points. The ABCD pattern works like this. So you start out with the lower swing point, okay, which is the initial breakout point, goes up to the higher swing point, which is your B point right here. Okay, then we retrace and pull back, and typically even a healthy retracement is 50%, and then we get into the C to D leg. Okay, so our C point, which is the swing point here, and the D point is right up here. So where do you enter on this chart? Well, you draw a little line right here. This is your consolidation, your retracement, and you get in it somewhere around this area. Okay, could you also get in it a little bit beyond right there, beyond the B point? Absolutely, but again, your range is less. So how does this really work out? And how do I know that this pattern is going to work out? And how far will it stretch? Well, here's the thing. Normally, this is not going to be your money leg. Okay, the A to B, it's kind of a lost cause. Some people may make it work. For the ABCD pattern, if you didn't catch it, just say move on, next. So your entry point will be somewhere around this range or breakout of the point B. Now, how do you project how far it's going to run? Well, you do a measured move. Okay, so again, the swing point from A to B, you can look over here on my chart if you're not familiar with it. It's going to be on this area, 155 points. Now, the measured moves don't always work out perfect, okay, but it gives you a rough idea. So again, if we would take that further, you can see we have about 147. It's really interesting how that works out. Works out very nicely. So that's the ABCD pattern right there in Tesla. Of course, you're always looking for volume on the breakouts. Doesn't matter which pattern you're talking about. You'd like to see more volume. Sometimes you don't get it, but it's more conviction if you do. Now, I'll briefly touch a couple other patterns real quick just to give you an overview of all of them, and then we'll come back as we have more time to cover all the other ones. Okay, stair-step pattern. We'll take a look at square, which is quite popular here. Let's see if it'll pull up. If not, we'll pull up another one. Let's see, win. Win right here will go into the downside pattern. Okay, so stair step can work to the upside or the downside. All of these actually can work to the upside or the downside. So when you look at this, you can see that the stock creates kind of the stair step effect. Are you the type of trader that's going to probably get every single step on the way down? Are you going to be getting it all the way at the very top? Probably not. I'm not that good. I don't know if Ken's that good. There's not a lot of traders that are that good to hit the top or hit the bottom. So as you start looking and evaluating this pattern, you start saying, hey, remember, we're in pattern recognition mode here. So if you're good enough, you can maybe recognize that the pattern goes sideways and then we break lower. Again, volume slowly starting to build, right? So you're looking for that build in the volume. Again, we move sideways and we break. We move sideways and we break. We move sideways and we break, sideways and we break until we get a longer digestion, which we'll talk about later. But you can see that this whole area is your stair-step pattern. It really, you can get in on any one of these points. Now, of course, the earlier you recognize it, the longer the run that you'll have. The further down you go with it, well, the less reward you have on that pattern. It works to the upside, works to the downside, and you're always looking for volume on these, on the breaks, more so than on the consolidations. So that's kind of the stair-step pattern, and you're noticing the consolidation there that goes with it. Let's see if we can go back to square, and there it is. It pulled it back up. So if you look here on the daily, you can see right here the chart stair-stepping on the way up, right? Fairly easy pattern to kind of recognize. I've been putting this out for my members as well. There's a lot of stair steps right there, and the sooner you can recognize it, also works out real well. There's no specific measured move that you can do on this, but typically the breaks will be similar from what I found and the things I've read, is that the up move is going to be almost as much as the consolidation point. So you can look at that projection. How many stair steps are you going to get? Depends on the stock. You know, some stocks can run like this for quite a long time. Other stocks, you may do a couple stair steps and you're done. But typically what I found, the reason you're looking at these patterns and these kinds of charts and looking for pattern recognition is once you see and recognize a pattern within a certain stock, it's going to happen time and time again. So when we did win, there's also an ABCD pattern that goes with it, but we did the stair step pattern. You can find more stair step patterns probably in the future and also the past. So take a little bit of time to do your own homework there and research this, but you'll notice that over time, you can really, the stocks, they will move the same way. Just like if you have a friend that constantly gets angry when, you know, you show up late for dinner, they're gonna always be angry when you show up late for dinner. It just always works out that way, unfortunately. So the same stocks, they have their personality. So if you learn to recognize it through these patterns, then you'll be able to see the potential in the future run-ups or the breakdowns. Let's look at a consolidation pattern and a break. We'll talk again actually with Tesla, just so that way you get very familiar with at least one of the stocks, because this one had some real nice patterns and very clean patterns. So as we look here, let's see here. Oh, something froze up. There we go. As we take a look here, long consolidation. This one lasted multiple years. Consolidation pattern from 2011, 2012, and 2013. And then we had a break. Huge breakout. But it took all that time to build energy and build gas to get that pattern to break out. And that's why it broke out so quickly, is because of all that building momentum and energy. Think about it, like compacting energy into a little cylinder, into a little ball, and eventually, boom, it explodes. Same thing here, compacting, just like a train. Keep putting that coal, the wood in it, gets tight and explodes, boom. And this is what consolidation and break does. In certain situations, you get a break and then you get a retest of that break and then it moves higher, right? So right there, it'll retest that level. So on the break, where's your entry point? A little above that break, right? A little above that breaking point. Why a little bit? Because you never know if it's going to go up and reject. Sometimes they like to go a little above it and then sell off. So especially if you're looking for longer term moves like a weekly and a monthly chart, you definitely want to give it a little extra cushion room because you're looking for bigger runs. You're not looking for $1 or $2 if you're looking at longer term charts, right? Look at this move that we've had. You had 148 points. Over here, you had another 143, 150 point move. So you're not looking for $1 or $2. That's what you're looking for, is you're looking for a nice consolidation. The longer it consolidates, usually the nicer or bigger the breakout. Sometimes this can also work against you in distribution. It also works the same way like an auto zone here. Let me just quickly show you. When you have a distribution right here at the top, it consolidates for a long time and then it breaks down, right? So it works the same way to the downside as it does to the upside, consolidating and break. But one key thing, the tighter the consolidation, which you can see right here, if it's tighter, the more compact, also the stronger the breakout. And of course, want to watch for that volume. Everything here, volume is key. Okay, so that's the third one, consolidation and break. And let me just point the camera down for you guys. So we covered Tesla on this one. And then the last one that we have is a break and test. Now, this is kind of a give me in a way because it's similar to the consolidation and break, okay, but it's retesting things. So if you miss that initial break, sometimes it comes back. And even if you get into the consolidate and break pattern, and then it comes back, you have to remember that it's okay. You know, you're not going to get a perfect run every time. Now, I'll go ahead and show you an example here. We'll do, let's see, Alibaba. Do I have Alibaba weekly on 2017? So here's the daily, here's the weekly. Okay, let me see here. All right, so here we go. So take a look at this little area, and sometimes it's a little tougher to see it. And this is what I was talking about, that, you know, not everything hits perfect. You could try and draw the lines exactly perfect every time. But as I always like to say, Does your friend show up to dinner always at 6 o'clock exactly? Usually it's 6:01, 6:02, sometimes it's 5:58. And even here with the webinar, even though we're scheduled for 8, we actually kind of were already on screen right around 7:57, prepping and doing some things. So here it is. When you look at this consolidation pattern, you can see there's a little bit of issues here, maybe potential break here, but here was your breakout point. In either case, there's your big breakout point, there's your volume, so your entry point would be right there if you were doing the consolidation and break. And you wouldn't be wrong, right? You had the volume, you had the price action, you had the wide price spread, it's good to go. But the issue is the stock wanted to come back and retest it, and it came back on lighter volume, right? So we came back on lighter descending volume, and that's a good thing, because when you come back on lighter volume, that means you're reducing the selling pressure. And then you had more volume starting to pick up. It was slower, but it was starting to kind of pick up right there. So you could get in it right there a second time if you missed it there the first time. So that's kind of one way to do it. You could also kind of wait for this high of that retracement level to break and do it a little bit up here, which again, you're looking for some volume to pick up. Everything is all about volume, but that's ultimately a third opportunity. And you don't always get these opportunities when they pull back, especially in markets that we've had recently with things constantly grinding higher and higher. So I hope that kind of gives you some good insight to these patterns. Now, keep in mind, again, write these down or take a look at these and you can study them yourself. I'm going to go through some of these fairly quickly now as well to give you some insights on some of these patterns and show you what they look like. If you have questions on any of these, by all means, email me, send me a message. I'll be happy to share them with you. But let's take a look at the ABCD pattern with CMG, right? So here is our A to B, B to C, C to D pattern. And you can see the C to D is your money leg. You probably missed the A to B, and it's okay. I don't always get the A to B. It doesn't always work out, but the C to D is your money leg. If you do the calculation right here, okay, it's a multi-year pattern. 3.5 years, you have 388 points. Okay, if we do the distance here, you can see about 521. So about an extra 120, 140 points, it went higher. And that's okay, it's stretched. How far is this pullback normally going to be? Well, what did I say earlier? It's going to be about roughly 50%. So again, we take the swing low to the swing high, and you get your 50%. It's amazing how that really works out. Okay, so there's an ABCD pattern. You also have it, actually, if you zoom in a little closer, kind of on a ABCD downward, but you can see these patterns are messy. And my point here for you, again, is looking for clean patterns. If you pick a stock, like let's pick any stock here, and it doesn't have that pattern, and you can't find a pattern, you're trying to find a pattern in this stock and you can't find it, move on. Use the word next. Go to the next one until you see the clean pattern. As you get better with it, you'll find things and you'll learn more chart patterns. But in this case, move on, go to the next one. Okay, Apple, same thing. A, B, C, D, longer term pattern. Here, A to B, B to C, C to D. And you could actually go and backtrack it to the earlier pattern, okay? A to B, B to C, C to D, okay? Again, let's do the distance. Let's take a look, okay? About 85 points from 2009. And then from here to up here, about 76. So very close. How far is the retracement? Okay, from here to here, A to B, look at about 50%. So your entry point would be right here. If you want to wait for the highs, you could get in it right here, but then you don't have a lot of room left to go, right? We do a little descending line, so that's your entry point, okay? Of course, you could look for some other subtle opportunities depending on what it looks like to you, but either case, that's your entry points once it makes that turnaround, because that's your C to D leg. Let's look at win. ABCD pattern. Again, this is the weekly. If you want to go to the monthly, you could do the monthly. That's fine too if you're a longer term trader. A, B, C, D right here, 142 points. And then up here, 165 points. Very close, very close. So here's the pattern if you haven't seen it. If you want precise calculations, you could take the swing highs to the swing lows. But you can see we stretched a little bit, and usually to the upside, they always stretch it because of the euphoria. But again, where's your entry point? Okay, probably right around this area. Okay, you could also do it after it breaks out somewhere around here, but then you have less reward. And your retracement, of course, right here, right? 50%. I'll throw another one in here just because I traded this one real heavy when it broke out. A little bit tougher to see maybe now. Let's see if we can go to 3-day chart or even 2-day chart if it goes back. There is an ABCD pattern actually from here to here, here to here, and here to here. And then there's also one to the downside right there. Very easy to see and spot. If you're a short trader or shorting, you like shorting, there's your breakout point right there. And that's where you get in it. Again, measured move here to here. You got about 60 points. And then about here, you project about 60 points and you're at 55. So you can see how these patterns work out well. You know, let's move on to the stair-step pattern on Amazon. And in here, you can even see ABCD patterns and stair-step patterns that kind of overlay sometimes. So as you look at this right here, we have some stair-step, stair-step, stair-step patterns. Again, you can get in on any one of these. And what you're looking for for these patterns is you're looking for a nice consolidation. Remember, the tighter it is, the nicer the break. Very tight, and you got a nice clean break right there. Okay, so you also have this ABCD pattern right here within it, kind of disguised. Just a matter of how you see things, right, with technical analysis and how you trade it. And let's take a look here at a consolidation and break pattern. Let's go to shop because we're running a little bit tight on time. So here, with this one, when we look at a consolidation and break, I mentioned this one in Tesla. So here's our consolidation. Very nice, very tight consolidation pattern. There's your breakout point. There's your volume point. Very good. And you can see the descending volume as we're in this consolidation area. So that's why your breakout point is here, because the volume kicks in right there at that break. Now I'm looking at the 2-day. Could you do it on the daily? Absolutely. Right there. There's your daily. Same thing. You could do it on the next day or the 3rd day, 4th day, 5th day. It does not matter. If you want a clean chart and you're struggling the noise, put it to the weekly. Put it to the weekly. You can see it here. There's the volume. Boom. Does it matter you get in it 2 weeks later? No. No, it does not matter at all, because if you got in it right at the break, and I always used to want to be the first one in the trade. That was me, and that's really what hurt me. I always wanted to be the first one in the trade, and then it reversed, right? So if you're the first one in the trade and you're getting stopped out a lot and it's reversing on you, wait, give it a little bit of time. Because if you got in it right away and you look at the full overall move, 73 points versus 70 points, and you're worried about that extra $1 or $2, keep it simple. Wait, be patient. Let things set up for you. Let's look at PayPal. Consolidation and break. There's no retest on these, as you can see, because these stocks move, especially the new ones like the PayPal, the Shop. These stocks move, so they have that consolidation and break, like the Tesla that I mentioned earlier. Again, this is a weekly. You can see the volume compressing, lighter, ready to explode. Everybody's in it. Boom. There's the volume, picks in. And if you miss that first day, no big deal. You get in it 2-3 weeks later, you still got a nice run. Right there, nice run. And then you start taking some off, right? A quarter, a half, a third, whatever you want to do, because you will get pullbacks, okay? So those are nice consolidation and breaks. We've had Facebook. Facebook has a couple of consolidation and breaks, but I want to show you some that also don't work out with the last few minutes that I have. So you can see here we have kind of a consolidation, but it's a little messy. Okay, we've had one break here. Remember, we said the friend doesn't always show up at exactly on time, and then it whipped you back, right? So we had a consolidation, we had break, we had a volume. It didn't work out, right? Why didn't it work out? Well, not every pattern's going to work out. We could think of this pattern or chart right here as it's going to come back and bounce, which means retesting it and going further. And then I could say, okay, well, here was my entry point, or maybe here was my entry point, but it just doesn't always work out. So this is why it's always important that you watch to see if that pattern holds, because if it doesn't hold that level, all bets are off, because now it could get in here and start selling off further. You never know. You can't trust the stock. Now, in this case, if you look at it here earlier, kind of a consolidation and break pattern, we had it a little bit higher. I could draw a line here. You could draw it any way you want. And then right here, we had the breakout, volume picking up. And in this case, it worked out. Whereas over here, it didn't work out. So it's important that you recognize that not every pattern is going to work out for you. That is key. And the patterns I'm showing you are very clean patterns. And the reason I'm showing you these very clean patterns is so that you understand what you're looking for. Because if you have muscle memory when you're playing an instrument, you know what it sounds like, you know what you're looking for. But a lot of people, they get into things and they start looking at a weird chart and it looks all messy and you can't see it. And then you don't know what to do. You don't know what to trade. So looking for simple, clean patterns, clean setups, that should be your goal. And when you have a clean setup, if you don't, move on. Say the word next, right? You're looking for these clean movements. And here, sometimes on the daily, I remember for me, the daily was always tough to find. So I started going into the weekly, and it started to make things a lot easier. Let's look at another one that didn't work out. Here's a breakout and retest or a test. So here we had a consolidation. Here was our breakout point. We thought we would get in, right? Because remember, you have to take the whole chart into account. The stock had negative energy, so probably it won't work out because there's more to it than just looking at a pattern. You got to look at the bigger picture. That's why I always look at the monthly, then I get into the weekly, and then the daily. So when you go into the monthly, you know it's got a lot of weak energy right here. There's a lot of sellers there. So as you start looking at this pattern and you see we have this consolidation right here, and even though it breaks out and you have the volume, yeah, you could get a few points. It comes to retest. You think, oh, wonderful, the pattern's working out. But then you get that resistance ahead and it doesn't work out. And then it rolls back over. And that's kind of the issue. And then for a short seller, that works out great right there because that short volume was building up right there at that point. So you could see that short volume started to build. A little bit of a subtle tell, which as you learn more about charts, you'll really start picking up these things. But first learn to recognize the bigger picture of the pattern and what things can happen when they work against you. Here's last one I want to do because we only have a minute or two to go. FedEx. So here's the break and retest or consolidation break. There's your entry point right there. Okay, right after that consolidation, it comes back to retest it. Okay, so retesting this level, and then it continues to go. So when you look at this, you can see it didn't hit it perfectly, right? If you're looking for perfect setups and entries, it's not going to hit it perfect. You could draw that perfect line right exactly right there. I could try to zoom in on it. But again, like I said, your friend is not going to show up to dinner exactly at 6 o'clock on the dot with 0 seconds. So look at these patterns, learn from them, and build your own patterns as well of trades that you like to trade. I like these patterns because they're simple to teach. They're simple for many people to understand and grasp. Definitely make sure you're looking on, if you're struggling, start with the monthly. If you're a little better at it, get into the weekly. And then you can also apply this on the daily because these patterns will work on all time frames. It's just that new traders will probably want to stay away from the daily and the weekly. Okay, you'll want to stick more to the monthly or the weekly. As you become more experienced, you can increase your frequency of trades and you can get more into the daily. But at the beginning, be careful. Start out wide, learn the pattern, learn the charts, learn the right setups. And when you learn the muscle memory, the pattern recognition, you'll be set up for better success. So that's kind of what I wanted to cover today for you. Again, just a quick look back right here at some of these other ones that you can take a look at and review. As far as tickers go, there are many others as well. There are other patterns in ABCD that are not as clean that you can find. Same thing with stair step, consolidate and break, and a break and retest. They're a little less clean, but remember what I said. If they're less clean, just hit the word next and move on. So that's kind of my take, and I truly appreciate you giving me the time and energy to listening to me, and also for attending this webinar. I want to make sure I give you guys a little bit of something extra. So with Ken, my colleague that we've talked about, if you're interested, I have a special link that I created. I'll leave it up till Saturday. It's risetolearn.com/Ken. And it's the technical analysis course that I have that's normally listed. I think it's $649 or $695. Let me just double check. This is our normal price, $649 and $799 with a one-on-one session. And because you attended the live webinar, you can get this course for $375 and including a one-on-one session with me for just $20 more, because I always enjoy connecting with people, and I think it's good added value to really see things on screen for a one-on-one. So that's kind of what I wanted to cover with you. If you have questions beyond that, by all means, feel free to reach out to me on the website, The Rise to Learn. You can hit the contact on the support or the live chat over here, and I'll be happy to answer any questions that you have. And that link is risetolearn.com/KEN. So thank you so much for listening and for joining, and I hope you take the time to study some of these patterns on your own as well and dig a little deeper.
All right, well, thanks so much, Sasha Evdakov from our tradersfly.com site. I wanted to thank you very much for an outstanding presentation. I highly recommend Sasha's courses, and his YouTube channel is really popular, over 80,000 subscribers, and he's got books on Amazon, and really brilliant young guy to learn from. So he's one of the very few, I will tell you this for a fact, he's one of the less than 6 trading educators whose YouTube channels I watch regularly, because he's got really brilliant technicals and he knows his stuff. So I like watching his videos. So thanks again for being here, Sasha. I appreciate it.
Oh, thanks for inviting me. It was a pleasure.
All right, and let's see, for all of you here, can everybody see my charts okay? We're going to start off, actually, let's start off with the day trading chart, US Steel X today. We're going to look at both day and swing and longer term charts. Can everybody hear and see the charts okay? If I could get a few of you to let me know that you can see things well, I would appreciate it. Hey, thanks, Ron. Appreciate it, man. All right, let's get started. One of my favorite patterns to look at is, or we got quite a few to go through tonight together as a team, is a minor gap continuation, or an ascending pattern, what I call an acceleration ramp, where you got a steady uptrend that then matures into a sharper angle breakout. Now, if you take a look at this type of chart on a close-up chart, you'll notice that we've got minor gaps. Now, I've traded as much as $4.9 million worth of trades in a single year, and I'll show you proof in a second, but minor gaps that continue are the number one thing I want to teach you is small gaps that continue up for both day and swing trading. Here's an example of Schwab, minor gap 1, minor gap 2. You may have seen my article in Stocks and Commodities magazine on multiple gap continuations. This is kind of a poker tell that they're so excited to get into it, they will bid out of market for it. US Steel was another good example that I covered for my live trading room members today. A nice minor gap that got new buyers. So that's an outstanding chart pattern. We're going to take a look at those and more in the next 20 minutes. You may have seen me in CBS Market Watch, Money Show, TheStreet.com. Just a quick intro. Here's proof. I've done as much as 4.9 million worth of trades. I made a few dollars along the way, 16 grand in a year, testing out hundreds of different actual live real money trade examples. almost 5 million worth of real money trades that I did back in '09, and I'm trading to this day. I know Sasha had mentioned Square. I was trading Square, and DHI were two that I covered for Money Show that I'm also currently trading. You may see me in every month's issue of Stocks and Commodities magazine. CBS Market Watch since dinosaurs roamed the earth back in '01, and the rest of it. I ran Day Trading University, now Trade Mastery, because I got so many swing traders, and a speaker at the Money Show events as well. So I've been all over the place. If your trading losses ever make you or your family say, "What the heck?" or if you conceal your trading losses from your family, stop the madness. There's got to be a better way. If you want to make money, if you want to really crush it as a trader, what Sasha said was exactly right about clean charts and say next if it doesn't have the pattern criteria that you're looking for as an active trader. We're going to be looking at, and these are kind of it for the PowerPoints, our strongest day in swing trading charts are minor gap continuations, ADX over 40 breakouts, and entries following wide candle days. And visually, these are really easy to spot. So let's spot them. Let's take a look at some outstanding chart patterns and what separates these from others out there. Let me start by giving you, I'm going to add on to what Sasha had said about Square, because this is one that I've been alerting my members to for the last couple of months. I posted a video for Money Show saying sell the nines, and I've been publishing that for the last 15 years. And so I posted a video on Thursday that I said, get out if it hits 49, and that's a good exit target. So my point is never buy anything with a 9 in it, because that's usually a sell signal. My institutional clients, as well as all the retail traders I've worked with over the years, this is a nice acceleration ramp pattern, a steady uptrend with a sharper angle breakout, and that's great, but nines always run into overhead resistance, much like whole numbers, but decade values at the 50s. So never, ever, ever buy anything with a 9. That's a fine place to sell with great enthusiasm, but never buy anything with a 9 in it. Another chart pattern that did keep going up a bit is DHI, and this is one that I'm currently long in, but I have a trailing stop at 49 because, again, once it runs, another good example of a winning chart pattern. Once something runs up week after week or month after month, professional traders, we always like to sell to the, guys like me, we're sharks. We like to sell to the retail traders. So I will sell it all day long at 49 after being in on a run up. Another quick thing that you might want to notice about successful chart patterns is that you want to have as tight and clean a pattern as possible. I'm not a big fan of reversals. I'm a professional breakout trader. I buy high, sell higher. Another thing to be on the lookout for is a large green candle at the right side of a congestion box. If you remember, Sasha had talked very eloquently about the ways to trade out of congestion, and he's exactly right. What I look for myself in my own trades is a tall green high volume candle, and as he mentioned too, volume is everything, and that's also exactly right. Traders vote with volume. Volume and volatility are what saves us as traders. So increasing volume for 3 days in a row, accompanied by a tall green candle. I use 50 cents above the high because I seldom see it the day that it ran. I might catch it a day or two later, and that's fine. You don't have to get in at the exact precise breakout trigger, but you are looking for a large green signal candle. This is kind of like a poker tell, like somebody's pupils are dilating or their neck, their throat is swallowing or something. It tells you that something's going on. So when you see a large tall candle in context of a pre-existing uptrend, especially in a nice tight well-managed chart like this one, it makes for a good chart to work with. So gap continuations and large green candles. But wait, there's more. How do you trade gappers? Because oftentimes you'll see gaps fade or they will fill. I like to buy not the day of a gap, but the day after or even 2 or 3 days after a gap. So if you see a little gap, that's the number one signal to use a professional trader, especially a high volume gap, which they usually are. The good trading is ahead. And even if you don't get in, even a week or two later, there's still plenty of opportunity to the upside. So always be on the lookout for minor gap, meaning less than a couple of points, less than 10% or so of a continuation play. So that's an inside gap. There's two types of gaps, all right? There's inside gaps like this where the gap occurs inside the previous consolidation range. This is a bullish cut pattern like the letter U. And you see a minor gap. You see a secondary gap here. And we see more ahead. So looking for minor gaps that continue to attract new buyers is a very good professional technique to use. Here, for example, what would be the strategy? I don't buy nines even if it was a gap. Now, I love buying gaps. That's what I do. I trade gaps and breakouts. But I still never buy anything with a 9. Now, it turns out it would have worked out fine. I would wait instead for a breakout above the nearest decade value, above the 40 or 40 and a half would be a likely inflection point at which I'd get in the trade. I always follow my rules because I found by being stubborn and not following my rules, I get in trouble almost all the time. So you want charts that are like people. You want people that are honest and reliable and hardworking, and they show up when they're supposed to show up, and they work hard. Avoiding the price action of a 9, we would have missed a little profit, but it still ran up, 3.5 points after that. So minor gaps that continue. By minor, I operationally define that as less than 10% of the price. So a $38 stock would be $3.80 or so, rounded up to $4. If it gaps less than 10%, we're good to go for a long continuation. If it gaps over 10%, you want to be cautious with it. But minor gaps that continue to get new buyers, especially, and the punchline is gaps are so easy to find. I mean, every single day we got gaps, right? So, you want to be very binary about this, right? We want to day or swing trade the attention of the markets. And you can see, for example, minor gap continuation. This minor gap didn't work out, right? It ran up, and I'm a big fan of break-even stops. So if you'd gotten in, bought the breakout above the 50 or so, and then it climbed back down here, you could get out near break even and then rebuy up at new highs. And again, not a trade recommendation, but this is a particularly good setup in E-Trade somewhere if it breaks over that 51 whole number. Oftentimes you'll find whole number support and resistance. At least that's what I found in my own trade. So oftentimes if something runs up to a whole number and fails to break above it, it's good to get out of the trade near break even or small profit or whatnot before it comes back down to your initial entry. But anyway, gap number 1, gap number 2. This is primed for a continuation breakout, and I'd be fine buying this guy over, say, 51.50. That's another quick tip. You've probably all been there, done that, got the t-shirt where you get in on a minor breakout, hey, it's going to run. Like Sasha said, being first to the trade. I used to do that too back in the 90s, and you learn that you almost always get stopped out, or over half the time you get stopped out. And then just to rub salt in the wound as though the trading gods had it in for you, it runs up without you. And that's frustrating, right? Ooh. We don't like that as traders. You don't like to buy it. How many of you, I'm just curious, how many of you, show of hands, have been directionally correct, but you still got screwed by the trade? You still lost money. Big picture, it did eventually go up, but not with you in it. You took the stop loss too early. And that's why I've taught so many thousands of traders to use a false breakout filter, as I published in Technical Analysis of Stocks and Commodities the last decade, and back before then, the Active Trader magazine, which is sadly no longer with us, or when I speak at money shows. So add 50 cents or so to the price before swing trading. And again, especially for the more expensive ones, over 40 or 50 shares. So 51.50 would be my earliest long, maybe 51.30, but I would not get in right at resistance right here because it may run up just enough to get the retail traders in. Then the market makers sit on the trade. It drops back down into consolidation, just enough to stop you out, and then it runs up to 60 without you, and it's very frustrating. I got a lot of traders there: Tracy, Dan, Mukesh, Koi, DMBW, Steve, Lowell just today. You and me both, buddy, and I've been there, done that, got the t-shirt. So when in doubt, stay out. Cash is king. Have some kind of a false breakout filter. Do not worry about the FOMO, fear of missing out effect. Should be a non-issue. Worry more about the fear of losing money, FOLM, I guess, or fear of taking big stops. If there's some acronym we could come up with for that. Here's another one, FOX. What's good about this chart? Well, a lot of things. And it did that pattern that Sasha had mentioned too, where it did a breakout. It came back, kind of ABC. It came back to support zone, forming the handle of this cup, Cup patterns are my favorite breakouts. Second favorite breakouts, actually ascending triangles are my favorite. My favorites are gap continuations. Second favorite, ascending triangles. Third favorite, cup breakouts. Anyway, you have a cup, it runs up, it pulls back to support, then it takes off with a minor gap. It's kind of like the poker tell or the clue. You know, if you want to be a market detective and you want to take a look for new breakouts, always buying into new breakouts following a minor gap like this guy makes sense. And even if you missed it, maybe it runs to 40, right? We don't know where it's going to go. Maybe it runs back down to 26. Anyway, somewhere north of the 34 whole number would be the place to get in. You would not get in at, say, 33.8. That would be a really stupid place to enter the trade because that's too close above the breakout. And I've done thousands of real money trades in breakout trading, right? I'm a guy who has traded just a little bit, you know, like 5 million worth of real money trades. This is my Interactive Brokers proof screen cap, nearly 5 million worth of real money trades in one freaking year. So I had a lot of coffee that year, a lot of coffee. I've been watching a lot of Craig Ferguson Late Show reruns on YouTube, so I like to have fun with this. Anyway, I've traded a lot of real trades, and I learned the hard way how to screw up and how to blow up trading accounts. Stop the madness. And I also learned how to make it. And the way to make it is to be very specific about the chart patterns that you want to trade. Here's another quick writer-downer. If you do want to trade pivot plays, it's usually best to wait for patterns like this where it recovers above a 50 simple moving average, you know, or the 100 or the 200. But you don't want to guess and gamble at a bounce, right? There's so many charts that sell off. I don't know what's one that's in the news lately. HMNY is one. This guy, this is one reason why I don't like charts that are, some charts are too volatile. What if you're the poor trader that bought at 28 and now it's down to 8? That's not good, okay? This formed the way that I used to be a statistician and quality engineer for the Ford Motor Company. So I'm a hardcore numbers guy and corporate numbers geek. But so anyway, these data points formed the 50 SMA. That doesn't help us as traders. This is catching a falling knife or a dead cat bounce. Stop the madness. There's got to be a better way. I may take a shot if it recovers 10 or 12, but the more intelligent place to look at it would be place way, way, way up here where new buyers are likely to actually come into it. Because we've all been in that pattern where something sells down and starts to bounce. Yay, I'll buy. Oh crap, I got stopped out. Wait, it's going to bounce again. Then I get stopped out again. This time it'll really work out. And then you get stopped out again. And you get frustrated. And then it keeps going down. You say, to heck with it, I'm never going to trade that again. The next thing you know, it's back up to 30 and you go like Homer Simpson. Don't! I hate when that happens. Anyway, the point is, don't trade uncertain patterns. Just like Sasha said, say next. Right? There's always other charts out there, kind of like meeting women at nightclub. There's back in my clubbing days back in Southern California. There's always lots of ladies out there. You don't have to settle for the first one that looks your way. So as a trader, have standards, have boundaries, have rules. Know what you're going to trade, right? Anyway, here's Macy's. The retailers had been, like Macy's and Nordstrom's, had been strong lately. You can see a nice tall green candle here, a minor gap continuation. You're always on the lookout for a sign that the imbalance between buyers and sellers has shifted and is continuing on the buy side. So you can see it's recovered all three moving averages. I use the 50, the 100, and the 200 simple moving average on a daily 90-day, 3-month, 90-day daily candlestick chart. For my swing trades, I also use a 15-day chart with a 15-minute candle pattern. And for my day trades, I use the 1-minute candlestick chart on a 2-day basis. So I can see the previous day's trend, the OHL's open, high, low, close, the average opening volume. If the volume is double that, that's another kind of a poker tell that buyers are in charge. And this guy ran all the way from 30 was previous day's resistance and a current day's support. And it ran how far? All the way up to the whole number. And it reverted to where? You may have seen my stocks and commodities articles, a mean reversion. And Sasha had hinted on this too. You often see these 1, 2, 3. I used to call them 1, 2, 3. You can call them ABC. Or heck, you could call them XYZ. You could call it whatever the heck you want. All we care about is where's the money. So anyway, after a big breakout, you'll often see a reversion or a pullback to the middle point and then a resumption of the initial trend. So often, and this did a little bounce, often those will move. So the pattern is a big one wave up, a retracement down to around 50% like clockwork today in X, right? And then often it'll resume the trend. Today, not so much, but often you'll see a 1, 2, 3 reversion pattern. Point being, whole numbers, 30, support, whole number, 32, resistance, midpoint, 31, right? And these patterns repeat themselves, and the sooner you can get up to speed on trading them correctly, the better off you can potentially be as a trader. You want to be proud of your charts. And speaking of pride, let's look at Pilgrims Pride running all the way from 28 or so up to 38. So a nice 10-point run. One of the biggest problems that you folks run into, and I've trained thousands of traders and used to do live seminars in Las Vegas and still do Las Vegas and New York and Denver and Dallas and California and all over the place, though I haven't done any in Europe yet, though they keep asking. But that's on the list to do some in London and Paris. But the point is, look, tight stops is rule number one, but only slightly less important is make sure that you trade instruments with sufficient percentage ranges. So for example, a chart that ran 28 to 38, that's good. It's got 10 points of range on a $30 stock. The numbers add up. I personally don't like the FANG stocks of Facebook, Apple, Amazon, Netflix, and Google because the numbers don't add. The leverage is relatively poor. And I'm not a real big fan of these cheap, junky up and down charts either, because that's just going to get you in trouble. Okay, like meeting some woman at a nightclub that you never met and then letting her move in with you or something. Been there, done that, learned the hard way. That's not a smart thing. Same thing, don't take home charts like this. It doesn't make sense. You don't want to buy breakfast. You want to just not take it home in the first place. So the point is, these kind of charts, yeah, it ran from 2 to 9 and you could have made a potential fortune, but the risk, you could have lost a fortune too, you know. Maybe you made a little trade on the way up and you got a nice breakout leg, and that's fine, and then you started feeling overly, it's like Han Solo said to Luke Skywalker, don't get cocky, kid, and that's the same thing. Then you kind of bet the farm there, you do 1,000 shares because you think, well, surely with that kind of run, it could keep going. Next thing you know, you're $2,000 in the hole, having to explain to the wife, how'd you lose so much freaking money? Do you know what we could have done with that money? And she wants to hit you upside the head. So just say no to charts that are extremely, this is like trading like a video game. Really stupid idea. Just say no. Don't have your greed glands say, well, gee, it could have gone from 2 to 10 and I could have made a fortune. You probably would have traded down here. You and every other average normal person in the world probably would have gotten in late and gotten stopped out. And it's going to bounce. I don't think so. Another stop. Oh, surely it'll bounce down here. You get stopped out again. Then you say go short, get stopped out on the bounce, and it just ends badly. What you want is consistency of charts. Charts with a reasonably tight pattern, whether it's something, you know, like Square used to be till it turned tail on its uptick, or DHI, going back to the dailies in these. Everything you do as a trader should start its life off with clean, focused, in-trend directional charts that make sense. A good, strong relative strength. You could go to moneyshow.com and type in my name and look at a couple videos that I had featuring these as the breakout charts of the week back here for proof that I know what I'm talking about. I featured both DHI and Square until here, and then I said, get out if it gets to 49. And same thing with DHI. I warned, get out if it gets back to 49, which it's likely going to do. But the point is, these kind of charts are easy to scale into. Brings me to a good risk management rule. And actually I need to do ADX as well, but a risk management rule is my 30% rule. Expect that over half your trades are going to stop out, because they are. Just get over it. Over half of your and my trades are going to stop out. Talk to any floor trader in the CBOE. They don't care what percentage of winning trades they get. They care about how much money they make or lose, all right? Should we all? It's all about risk management and allocation. Retail traders, what I say, and I did a Money Show interview, I said trade wide, not deep. Trade multiple occurrences. The ones that take small stops, that's fine. That's part of doing business. The ones that do work out, you can scale into. Okay, you should always add to winning trades. So your challenge as a trader, and I'll put this challenge in front of you, and from a guy who's actually really been there, done that, I will tell you, you need to look at every single trade as a pilot or a test trade or a feeler trade that you're going to add, kind of like seeds that you plant in a garden. Not that I would ever be patient enough to garden, but you get the analogy. You plant a lot of seeds. So maybe you're in a dozen different positions, 100 shares each. Half of them stop out, but you still made money because the other half you let go for, you let them, out of the other half, maybe half of those just went sideways, so maybe break evens. But the remaining 30% or so actually started to run, and those are ones that you add to. Now, my guidance for how at least I like to swing trade is I will add to winning trades every 2 or 3 points or so. So let's say I just done a baby trade, 100 shares here at the 42. I would add to it at 44, add to it at 46. That would likely be it. I only do 2 add-ins or 2 position sizing scale-ins, or if you call it legging in or laddering in. Usually 2. I've done more in the past, but usually 2 is the limit. And then sell it all at 49. And you leverage your P&L much more effectively by doing that. Another example of the rule of nines, to sell everything with a 9 in it. Weight Watchers have been really good till it wasn't, and it reversed course right where I told my traders to get out at 39. Another good example here. Do you see that? This is Weight Watchers. This is what's called a bearish engulfing pattern. For those of you who've learned candles from my colleague Steve Nissen, the only person you should learn candlestick patterns from. Anyway, you got a bearish engulfment here. I told everyone to sell 39. And that's why. We had been telling them long on the way up, and we got out at 39 because it'll often pivot back off the 39 and not really worth trading ever since then. It was a great story until back in July, and after summer, Weight Watchers went on a diet, and it went sideways. So we don't want to buy we don't want to buy that. We don't want to trade that any further. But anyway, those are the type of patterns I want you to start getting your head around in terms of good high velocity breakouts. Another quick one I will leave you with. What if this market sells off? How many of you think this, share my sentiment that the stock market is bubbly and about to do the mother of all sell-offs any second now? How many of you, show of hands, type the letter Y if you agree the stock market's going to sell off like a son of a gun sooner rather than later? How are you going to make money with it? I'll tell you how I'm going to make money with it. I've got my buy trigger set up as we speak in my Fidelity account to buy VXX, one of the inverse ETFs. There's a lot of them out there, but that's just a quick parting thought is good question from Rebecca. A lot of testing. I was doing a lot of testing, very tight testing. A question, why did I only make 16 grand on nearly 5 million worth of trades? Because I was doing lots of testing of patterns. That's the foundation of my business is I test things out with real money trades. The stuff that works, I look for commonalities, for common patterns that things share in common. And that becomes the foundation of my courses and my subscription services. Things that don't work go to the waste bin, right? They're the dustbin of history. So it was all in service of testing patterns. So I was doing, my goal was to test as much pattern strength as I could. A horrible way to trade is to do like 1,000 or 2,000 or 3,000 shares of 2 or 3 instruments for either day trading or swing trading because your upfront risk is too big. A smart professional way to trade is to trade a lot of different instruments on small size the right way. So anyway, an instrument that I will be trading on a bounce is VXX. What I like about it, kind of a parting thought here, and I'll see if I can find another example, is look for a lot of recent green candles. Like out of the last 5 or 6 candles, what's the ratio or the mix of green to red? Kind of like the air fuel mix in a carburetor in an old time car. For those of you who, like me, remember when there was a lot of cars, cars that had regular carburetors with actual gasoline. Anyway, the point is the mix is green here. We have mostly green candles on VXX. Now, if we look at what happened last time it broke above the 50 SMA, that didn't end so well that time and this time. So we don't want to use the 50 SMA as a long signal. The earliest strong long signal in this guy is going to be way up over 40. I may take a couple of test trades up over 37 because that's above that horizontal resistance and this resistance and above that MA line, over 37 and again over 40. But if you look at this guy, you know, VXX, a lot of the inverse ETFs, this is where it had been trading back in the 2008-9 sell-off, a split adjusted $110,000 per share. Kind of feels like Bitcoin or something, right? So the VIX ETNs are really good potential for reversals that the market sells off. But the main message I want to leave you with is one of confidence and one of pattern recognition skills for identifying charts like this that make a lot of sense to trade. And I think, a lot of what Sasha's told you and what I tell you, has good commonalities because, good traders, great minds think alike, and we're looking for good patterns that make sense. So do visit Sasha's site at tradersfly.com or rise2learn.com. Visit me at trademastery.com. Let's see, I got just a couple of quick things here for you. If you want to join my Saturday shindigs, I've been doing these initially back in the year 2000 and 2001, back when we could only do text webinars. I was the first person in the industry to do Saturday webinars. I feel like Thomas Edison of the trading industry, right? I've invented so much stuff. But anyway, now I do trademastery.com/free, and that will get you in. We've got over 4,800 registered. To the best of my knowledge, it's the most popular ongoing webinar series in the industry. There's proof. I got 4,810 registered for these every Saturday from 10 to 10:20, and I do appear in webcam. I didn't tonight. I was impressed with Sasha's appearance. It looked great. I need to figure out how to do that green screen stuff on the webinar. But anyway, you can join me every single Saturday as my guest for a forecast. Almost no pitching. It's all just looking at updates for the key support and resistance levels in the S&P. 2 or 3 hot charts to consider for the week ahead. And if we have time, we even fit in a couple of questions. But that's from 10 to 10:20. So go to trademastery.com/free for that. And if you are a swing trader, you may want to do a 2-week money-back trial of my swing trading service at swingscans.com. Hundreds and hundreds of people have joined this over the years, and it's a premium swing trading service where I got my top 10 picks each week and downloadable videos, and the rest of it you can see a lot of information at swingscans.com. You can get a 2-week trial for $7. So anyway, with that wraps us up for tonight. I wanted to again say a big thanks to Sasha Evdakov for being here with me, and thanks to all of you. And we will be getting the recording of this out, and I'll be putting this on my YouTube channel as well, so it'll be there and you guys can watch it. I will be having GoToWebinar send you a replay link. So I don't know if you're still with me, Sasha, but thank you for being here.
Yeah, I'm still with you. Yeah, thank you so much for having me. I truly appreciate everyone sticking through the webinar and listening to some of the content and information. And, all I can tell you is just continue to practice, work at it, and learn to manage your risk. That's really the key, is manage your trades is really about managing your risk.
Yep, that is it. Risk management is 110% what you got to get good at. And the thing is, the math is a lot more important than the chart patterns. I say that and people kind of shake their heads. Well, I thought it was all chart patterns. No, the math, the numbers, especially as it regards to risk and diversifying your trades, the math, the numbers, the math behind the chart patterns, but the math of your overall trading portfolio mix is a lot more important than simply looking at chart patterns. So they work hand in hand. And speaking of that, Sasha's a really smart guy. I highly recommend his YouTube channel. I watch him regularly and have for months. He's great. He's a really brilliant guy. So check him out. And he's got books on Amazon. He's got a dozen books he's written already on Amazon, and they got good reviews. So Sasha Evdakov, he's an up-and-coming guy. I'd bet on him as being one of the upcoming successful people in the whole industry in the upcoming years ahead. He's smart. He knows his stuff. I think he's a good person for you guys to learn from. So thanks, Sasha, for making time to be here. Really appreciate it.
Oh, you're more than welcome. Thank you for having me.
All right, thanks, folks. We will see you next time, and I will get the recording out to all of you. Take care and best wishes for success in your trades.